To kick off the first trading day of this second quarter, after stocks having their best first quarter in 5 years, can the momentum last? That's a question we're asking. And to break down the catalysts and headwinds investors should be on the lookout for this quarter, we bring in Neil Dutta. He is a Renaissance Macro Research. Thank you for joining us here, Neil. Let me just ask you, we're starting a new quarter. We're coming off a lot of strength. Can this continue?
I think so. I mean, look, for me, as an economist, I think fundamentally what drives markets is actual and expected earnings and interest rates. Okay. And, my sense is that inflation is likely to moderate between now and June, and that should put some downward pressure on interest rates. And at the same time, this is still an environment where companies can make money, which should push earnings higher. So, from my perspective, I think there's room for equity markets to continue rising here. We could talk about different styles and so forth, but I mean, generally speaking, I think it's an environment of cyclical momentum. I mean, at the end of the day, guys, we're talking about how much is the economy growing and how much are central banks cutting. Right. That's a pretty good backdrop for risk appetite.
And so markets potentially here for the rest of the year trying to figure out, are new all-time highs warranted if we see less cuts on the interest rate side than expected? What would be your expectation there, and the perhaps calibration or readjustment of some of the real number of cuts that we could get?
Well, why are they doing that? They're doing it because the economy is better. If the economy is better, that means earnings are higher. If earnings are higher, that means stocks should go up. To me, you don't want the Fed cutting too much because that ultimately means that they're trying to stem a deep earnings and economic recession. So, I think what we're talking about now, and I think that's part of the challenge, is because we're so used to the Fed cutting not at all or very much. And that's not what we're talking about right now. What we're talking about right now is a recalibration of policy because inflation is coming more under control. It's not an environment where the Fed can aggressively ease policy because the economic data simply don't justify that. But if you think about the unemployment rate and inflation and kind of trying to tie that into a simple kind of policy rule, it basically suggests a modest recalibration of recalibration of policy, maybe 2-3 cuts. That's sort of where we're at right now, and I think that's the right call.
So do you see this evolving as a kind of 90s scenario where the Fed was raising rates 94, 95, ran into a little trouble in 98 around long-term capital management, held off on, but eventually cut? It just seems like the soft landing scenario is an historical aberration, and yet it's been the base case for so long. I'm just trying to wrap my head around, is this an actual repeat of something that is an historical aberration, that soft landing that eludes the Fed so many times?
Well, I don't know that it's as much of a historical aberration as people make it out to be. I think you could argue that right before COVID, the Fed pulled off a soft landing, and you mentioned the 90s. I think it's more like 95, frankly, than 98. I mean, I don't see 98, remember, was a period where we had big financial stresses coming off global economic and market problems like, Russia, LTCM, the peso crisis, and all the rest of it. This doesn't feel like that. I mean, if anything, the Fed hiked aggressively, and we didn't really have much discussion of balance of payment crisis in emerging markets, which is what you typically see when you have, rapid Fed tightening cycles. So I think, from that perspective, the global economy, particularly emerging markets, seem a lot stronger today than they did back during the period that you're talking about. I think the make or break factor for whether this is going to be like the 90s is really whether productivity continues its ascent. We're coming off a period of very strong productivity growth. A lot of that's just driven by, stronger demand, frankly. But, if we do get a little bit of capital deepening, if, we continue to see these normalization dynamics from the pandemic, productivity can be growing at a more normal rate. And that basically allows the Fed, gives the Fed space and allows them to recalibrate policy without having to worry about much inflation pressure.
Got to ask you about Japan here. It seems like a boogeyman just hanging in the wings. We got the yen this weekend to, a 30-year low, and it looks like it might be pressuring the BOJ to spur some kind of action after it raised interest rates for the first time over a decade. I'm just wondering, What concerns should we have about Japan, if any?
Well, I certainly think, I mean, historically, currency interventions from the Bank of Japan have been fleeting. I mean, they've led to some temporary adjustment in the currency, but they haven't really done much else. And I'd expect that this time, I mean, to the extent people are speculating about it. Obviously, there was a lot of concern over what would happen with carry trade dynamics after the Bank of Japan telegraphed a hike. But, you know, it's important to remember that despite that, interest rates in Japan are substantially lower than the rest of the developed world. So, you know, I'm a little bit skeptical that it would have that much of an effect on global asset markets. And that seems to be the case so far.
And so for the companies that have the most international exposure right now, and specifically we've been zeroing in on China and the type of hit that we could see to revenue or even profits, as there's still more of the tit for tat that's taking place. What most notably would you be watching for within that region to give a sense of just how much detriment could be incurred by the companies that have the largest international exposure?
Well, I mean, companies have been diversifying away from China, some more so than others, but it's important to remember that a lot of final assembly has leaked out of China over the last number of years already. You know, in terms of what investors should look for, I mean, in my experience, what happens really is essentially a tape bomb effect. You get some negative headlines, you get, you know, political back and forth between the two countries, and that's what tends to weigh on equity market prices more so than you know, sort of the fundamental analysis of how much we're exporting and so forth to these countries. I mean, but, you know, it's a headwind for sure. But again, as I mentioned before, it's important to remember that despite all the weakness in China that we've been talking about, sentiment around China is quite weak. And emerging markets around China have been doing reasonably well, all things considered. So, you know, to the extent that China stabilizes here, I think it's probably a positive for the global economy.
Neil, thanks so much for taking the time here this morning. Neil Dutta, who is the Renaissance Macro Research Head of Economics Research. Appreciate it.
Thank you.